Hi, everyone, and welcome back to the Atlas Annuity Podcast. This is episode number 24. I am your host, Marty Becker, owner and founder of Atlas Financial Strategies in St. Louis, Missouri. So, today I want to talk to you about annuities as a replacement for life insurance. When I actually first came into this business as a client, I came in as a client of a whole life insurance policy. Now, that's another one of those things that is very misunderstood, like annuities. But once I understood the truth and the value of them, I was sold. So it was actually a way for me to solve my own retirement problem, which was giving me a vehicle that allowed me to have liquidity, get some guaranteed growth with tax advantages, and also to cover my family in case of an early death. And now that I'm 8 or 9 years into this process with that policy, I can honestly say it has been one of the most invaluable decisions I have ever made, because that is a whole life policy, meaning it's going to pay at some point in my life. The insurance company already knows that they're going to have to pay that death benefit out if I don't drain all the cash out of the policy. So that is a tax-free asset that I will always have, no matter how long I live. So what's interesting, I came across this quote that says, "The deeds you do for yourself are gone when you pass away, but the deeds you do for others remain as your legacy." And the reason I say now that I realize that was one of the most invaluable decisions I've ever made, it's because there's an interesting phenomenon that starts to happen as people get older. They hate life insurance during their working years, and they really just see it as a necessary evil, along with the people who sell it, which is why I never thought I would ever be in this industry ever, because I didn't like those people either. But also, as they age, they start to think beyond themselves. Okay. They start to think about what they want to leave behind as a legacy. But unfortunately, by the time they get to that point and they realize that life insurance is the best way to leave money behind to their beneficiaries, and that could be family members, it could be friends, it could be charities, it doesn't matter. It is the most efficient way to leave the money behind. But a lot of times when they get to that point in their lives that they realize that, and that's something they want to do, they may not qualify for life insurance. And if they can't qualify for it, they may not be able to afford it, because obviously the older you are, the more risk you are bringing to the life insurance company, and it becomes cost prohibitive for a lot of people. And now when I say as you get older, I'm not even talking about people in their 60s or 70s. This is more for people based late 70s, early 80s, because there still are options in your 60s and 70s to put a lump sum of money into an insurance policy that actually will help keep the money liquid, and it will increase the death benefit on day one. Plus, the death benefit and the cash value will grow every year, and then everything will get passed on tax free to your beneficiaries. So if you're in your 60s, early 70s, there still is an option for life insurance, even if you do have some medical conditions. Late 70s, early 80s, it gets very cost prohibitive. And most of the time, if you're over the age of 80, they will not even issue it to you. So, what is the option for someone in that age bracket, or someone who does have a medical condition that they just flat out cannot get approved by a life insurance company? What's interesting is I get phone calls on certain subjects consistently, it seems like, and they come out of nowhere. I'll have one person ask it, and then I'll have five more people call me and ask me about the same thing. And recently, I've had numerous people reach out to me for this very objective. How can they pass more money along than what they have right now if they can't get qualified for life insurance? We can actually look at using an annuity in place of a life insurance policy. So, how does that work? Because obviously, if you put your money into anything and it grows from interest or market returns, whatever, you're going to pass more money on. So, I'm going to go beyond that today and show you how do you leave a larger legacy on day one, regardless of what the market does. you can do that with an annuity that gives you a bonus up front. And I'm not talking about income annuities that give you bonuses towards your income value. I'm talking about a bonus that goes directly into the account value on day one and gets added directly to that death benefit. So some of these are just standard fixed indexed annuities with no fees. And at the time of this recording, there's a lot of choices out there with bonuses from anywhere from 8 to 16%. Think about that. Even just with a standard fixed indexed annuity, you get an additional 16% on day one with no risk of a market downturn and no fees eating away at that principal. However, you do want to make sure that you do read the disclosure and look at something called the vesting schedule to make sure that full amount would be passed on if something were to happen to you in that first year. And also keep in mind with these type of annuities that there could be different terms or brackets, if you want to call them, based on your age or based on the amount of money that you're putting into that particular type of annuity if you're looking to leave it in place of life insurance. So smaller amounts could get smaller bonuses, larger amounts could get larger bonuses. But there is one type of annuity that really works out the best for this particular strategy of using it as an alternative to life insurance. And the interesting thing is there's really only two companies that offer this type of annuity. There is a third company out there that has a version of it, but the benefits don't seem to be as immediate as the other two. So the way that it works is on day one, you will get a 45% bonus that goes directly towards the death benefit. Now, I've been dealing with these two companies that offer this particular product for close to 10 years now, and I've never seen at least one of them not offering at least 25% bonus towards the death benefit. And that's at any given time. They know they're in competition with each other, so one is always trying to outdo the other one. But at the time of this recording, it's 45%. But let's just say you got the annuity when they're only offering 25%. You just need to ask yourself, where else are you going to get a 25% increase on every dollar that you put into this that can be passed on to your beneficiaries, and do that with no market risk and no fees, and do it on day one? You can't. That doesn't exist in any other type of investment. Now, here's the other interesting thing is that benefit doesn't just stop there, okay? Because it is a fixed indexed annuity, and it's going to do what a fixed index annuity is designed to do, which is continue to grow. So on top of the benefit bonus, not only are you going to have growth opportunity, but these particular annuities from these two companies will give you a substantial increase towards the death benefit based on what the indexing growth is. Now, what does that mean? So let's just use an example of $100,000 that you put into it, okay? And let's just say that first year you have 3.5% growth. Now, I like to be super conservative when I'm looking at the growth factors on these annuities because I always want to underpromise and hopefully overdeliver. So I always use 3.5% as a growth rate. Now, at the time of this recording, they're offering a 200% increase of that growth value towards the death benefit. So in that example, if you put $100,000 in and you have a 3.5% gain that first year, that's $3,500. They will take that $3,500 and multiply it by 200%, which is $7,000. So they're going to add $3,500 to your account value, but they're going to add $7,000 towards your death benefit. In this example, what would that look like after the first year? We have $100,000 that goes in. You get a $45,000 bonus towards the death benefit. And then if a 3.5% growth rate happens, you get an additional $7,000 towards the death benefit. That's $152,000 after 1 year. Where else, again, if the purpose of the money is to pass it along to others, where else are you possibly going to get a 52% return on your money in a single year? It doesn't happen. But again, keep in mind, this isn't magic. It's just math. So I know you're sitting there thinking, okay, where's the catch? Because annuity companies aren't just giving money away for free. And you're right, they're not in business to give away money. In fact, an early mentor of mine said there are no deals in the insurance industry, which I personally like. You know what you're going to get. So if there is a catch of how they can actually make this happen, it's this. If you're going to have that increased death benefit, your beneficiaries have to be willing to take the death benefit over a 5-year period. That's it. They just have to split it up into 5 equal payments, which allows the annuity company to recoup anything that they might be on the hook for. Okay. Now, if your beneficiaries decide they don't want to take it over a 5-year period, then they would just get a lump sum of the account value, which in this case would be $103,500 if you had that 3.5% growth rate the first year. Most of the people who are reaching out to me about this think to themselves, hell, my kids are making more money than I ever did. This is more for our grandkids, but we have to leave it to the parents, which is understandable. And if your kids are doing very well financially, they probably don't want to get a huge lump sum of money in a single year, because what that could do is it could bump them up into a higher tax bracket, and they could end up getting less of the inheritance of what you originally intended. So for a lot of people, the fact that they got to spread it out over 5 years actually works out very well. So that's really about as good as it gets for somebody who wants to leave money behind and cannot qualify for life insurance and does not want to take any more risk in the market. They just want to leave the money behind. But another important thing that we have to take into consideration is, if you're doing this, is, what about you? What if you need the money for something else? So these particular annuities that I'm speaking of are also unique in the fact that you can take up to 10% of the premium every single year starting on day one. So that means if you put $100,000 into it, you can take $10,000 every single year, even if the account value drops below 10% of that. That is very different from other fixed indexed annuities, where number one, you have to wait an entire year before you can access 10% of it, but then you can only access 10% of the account value. So if you had 100,000 and you took out 10,000 and you had no growth the following year, the next time you want to take a withdrawal, you could only take 10% of 90,000. So you would only be able to get 9,000 at that point. But with this one, you can take 10% of every dollar that you put in there. It doesn't matter the growth rate. If the growth rate's higher than the premium, you can take out 10% of that. Minimum, you'll be able to take out 10% of what you put in there every single year. Now, one of the companies has a 7-year option on this, or both of them offer a 10-year option. So again, this is something we want to define the purpose of the money, because a surrender period should not be an issue if the purpose of the money is to pass it along to beneficiaries and give them the most amount possible. One thing that we always want to be concerned about is an emergency of if you end up in a skilled nursing facility, or you're diagnosed with a terminal illness, and maybe you want that money to do some treatments that are not covered by your insurance. Pretty much every annuity, this one or any other one you look at, does have this provision built into it, to where if you do get confined to a skilled nursing facility, or you're diagnosed with a terminal illness, the annuity company will free up 100% of the money without any type of surrender charges. And then another important side point to this is, and this is nice, this can be funded with non-qualified money or qualified money, meaning tax deferred in an IRA or SEP IRA or 403, whatever. So, everyone, I think that'll wrap it up for this week here. This was a quick hitter, but for people looking to leave more money behind than they have in their current portfolio right now, with no risk and no fees, this is about as good as it gets for someone who cannot qualify for life insurance. And in some cases, it works out better. So I hope this helps anyone in this particular situation. And also, if you could do us a favor, if you could like this podcast or like this video on YouTube and subscribe to the podcast channel, or if you know someone that could benefit from this information, just click that share button, because I know there's a lot of people out there that are looking for a solution like this and they know they can't get life insurance. And then if you ever want to talk about your specific situation, the best way to get a hold of me is to book a short phone call at atlasannuity.com to view my calendar. And that way we can get all of your questions answered to make sure the Atlas annuity strategy is a good fit for you. Everyone, thank you again for joining me. This is Marty Becker, and I wish you all the best in your financial education.